Wolfram from our audience, from our participants. It says, could you consider a large, as in too big to fail, financial institution in Southeast Asia to go bankrupt or to go insolvent, and could it trigger a global financial crisis kind of situation? Could you foresee that? Could you put that in your scenario? Would you recommend that?
So basically, could you have a Bear Stearns kind of situation?
Lehman Brothers kind of situation.
Lehman
Yes.
Brothers. I mean, if you look at the list of globally significant financial institutions, there are only a few names on that that are truly Asian.
Right.
And most of the names that are on there that have Asian presence are what we would call the glocals or the globally, but locally subsidiarized banks. So in terms of institutions that are truly big enough to have an impact beyond the borders of their home market, and that can be more than one home market, there are not that many, to be honest, right? And even then, if you count some of the large Japanese banks, I think they would probably, if one of them would go down, that would trigger a crisis in Japan. But whether that is truly infectious beyond the borders of Japan in a big fashion is debatable, right? So the number of banks that are sizable enough to cause a huge problem across the board are relatively far and few between. So if you look at the local, the national champions in the individual countries that we're looking at here in Asia, are there banks that could trigger that? Let me put it like this, individual banks going down for idiosyncratic reasons, I would say no, the local markets will be resilient enough and the local regulators equipped enough to avert a broader crisis. However, most likely the scenario where one of these banks goes down would be a larger macroeconomic crisis scenario. That means at the same time all the other banks would be in trouble too, right? So coming back to the question, I mean, is it possible? Yes, of course it's possible, and as part of your stress testing, you should at least take a look at that. How plausible do you think it is? Is it acute? I personally don't think so. Mm-hmm. Right? Is it of interest to the regulators? Yes, of course, because they need to take a look at the macroeconomic stability in their own backyard, right, so to speak. So from their perspectives, yes, they need to account for that in their stress testing that they do. But I would not necessarily see this as a primary concern for most banks at the moment.
My observation is, whenever there is an idiosyncratic reason for a financial failure, we eliminate that because those are solvable issues through diversification. So we typically not take that unless there is a macroeconomic reason that causes one bank to fail and then it leads to a series. So a single institution that can be that.
Well, again, it also depends on what the cause of the ultimately what causes the crisis, right? If it's if the cause is a fall in asset values, and everybody looks at that and thinks, well, if the asset values in this bank are down, does that mean all the asset values in all the other banks are down too? And then, of course, that leads to a loss of trust into the banking industry as a whole, with market-wide consequences, right? But if you say, well, this is something, a rogue trading incident or a conduct risk matter that just affects this one bank, and that might be very bad for that individual bank, but just because that rogue trading incident happened at this one bank, that doesn't mean it is bound to happen at other banks, particular banks with less of a capital market exposure. Right?
Those fraud incidents and rogue trading, etc., are something to worry about, and that's where the chief risk officer's job going into that, into preventing these rogue trading, fraudulent behavior, etc. So that goes to Anju again. There's a question from our participants that we noted some financial institutions in Australia foresaw from the stress test that their capital may or may not be adequate. So prior to conducting the stress test, they raised their capital. How would you interpret that? Was it that they were expecting to fail? Were they inadequately placed, or is it a precautionary measure? Any reactions to that?
I think they were just smart. Um, I think some credit to be given to the fact that the regulators have done a good job of trying to pick up some of the pieces of what's going on across the world and surge forth with and responding to it in a way that's forward-looking and looking at potential bad news in its face with less hesitation. I think the second thing also is that there is basically the 4 large pillar banks in Australia, and there is a lot of economic dependency on those 4 banks. Their types of businesses have variations, but they're quite similar. And one would imagine that in that sort of an environment, it's prudent to be a step ahead because the contagion could potentially be rapid. I would argue that across Asia, most of the time it would not be idiosyncratic. And if it's not, then it will apply to all. And we all know that in stress testing, I mean, I actually have a pretty dire view. When bad things happen, they all happen at the same time. And that's how the House of Cards falls apart. So being proactive and actually managing the risk is prudent. And I think the Australian banks have always been quite alert to not only asset quality, but some of the other risks, particularly liquidity risks and what goes on in the markets and how the money moves. It's very relevant to the business, and all of those factors would have fed into their thinking.
Thank you. Well said. Any further questions from the audience?
Or these agreements?
I have a. Are there any regulators in the audience here? So, there's a question.
Good afternoon. There are a lot of inherent risks that are not quantifiable, like we talked about political risks, we talked about the risks coming from the unethical business behaviors, integrity kind of things. So is there any specific model or quantitative techniques to set a benchmark addressing these risks for this stress testing? Any particular model or the quantitative techniques for setting a benchmark or the shock parameters, I would say?
Anju, would you take that question?
I think I can kick it off and we can combine it with some of the quantitative techniques that you adopt. Even when we talk to the regulators, for example, about managing risk across different countries, they're very keen to know which country are you operating in, what are the risks you're facing into, could you potentially be facing into a fine in that regulatory environment because you had a misstep on AML. And we know that misstep in AML needn't really be an incident. It could just be a process misstep. So, and again, it goes back to the same theme, knowing and acknowledging to yourself your own vulnerabilities. We typically, as organizations, know what is the culture of the people in our dealing room? Where along the curve are they on totally getting into their DNA a strong conduct management? And is the learning curve very well embedded? Is it somewhere along the curve? I think most institutions would acknowledge and say, you know, will say they're doing a good job, they're training their people, they're doing all the right things. But when we evaluate the risk, it's a combination of qualitative and an overlay of then the qualitative risk getting converted into a quantitative risk. And it's the, for want of better words, it's the quality of the analysis of the qualitative risk that will lead to an honest quantification. So the truth will be in the acceptance of those risks. And as true as those acceptances are, the numbers will be meaningful.
Any comment, Professor?
Back to the question, I think there's something really interesting to know if that model really exists or ever existed. To say this simply because it sounds that we are trying to simplify the sort of operational, environmental, and all those sort of pertinent risks really surrounding us. And it also amounts to something like panacea. If that can be really found, then commercial banking or banking at large will be crystallized like modeling, which I really don't think that would happen. But that said, I think the real attention, like you are driving on the expressway, should always focus on the direction that you are heading. If you are heading for the airport, you really should know, deep down that where you are going. So that thing, or the sense of direction, sense of orientation, should be always the most important or the paramount attention for whatever managers or business owners. And on top of that, we do need some techniques in guiding or charging the sort of paths that we're going to travel. But those things are eventually just technical. And therefore, you have a basic fundamental things in mind, and also try to be as strong as possible in your own operations. Someone can be ignoring the risks around. He could be lucky, but he can also be jerked into some real deep holes that obstructed the operation and also the very existence. So we really cannot just rely on just one model or the sort of model that can pave your way and let you have a careless sleep in the night all the time. No, that thing wouldn't be existed. you really got to study what's happening around you, what's happening around the sector that you are in, and also the market-wise environment and the risk therein. Thank you.
Okay. Yeah, a couple of comments on top of that. I mean, first of all, I think we need to differentiate between quantification of risks, which in many cases we can do through proper design, and the modeling, i.e. the prediction of things, or whether things will happen. In a lot of the operational type of risks, right, for the longest period, banks have tried to put numbers on that. There's been a lot of effort gone into that. And actually just very, very recently, it's hot off the press, essentially, that the Basel Committee assessed that they will likely abandon the advanced approaches for operational risk because the amount of effort is in no relation to what you actually gain from doing that. Which brings me to another important point, and that is materiality, right? So in the broad scheme of your stress testing, so when you're looking at the top of the house stress testing, and you're asking questions about what can bring down the house, a lot of these unquantifiable or not modelable risks, yes, they are important. They might be very important for your P&L, so your next year results, but they might not necessarily threaten the survival of the bank, right? So they need a different treatment. Those top of the house risks, and obviously a rogue trader, for example, is one, a major conduct risk event is another. The way to deal with them partly is through good design of your scenarios that you're looking at. But there's a lot of talk in the industry around capturing second and third order effects of risk types. So let's say you have an event, you start off with an asset price shock that leads into a loss of confidence in your institution, so depositors leave, and you end up in a liquidity crunch, right? So what happens with an asset price shock ends up to be a liquidity risk event via the way of a reputational event, right? So do you necessarily need to have a model to predict and quantify reputational risk? No, and you probably wouldn't have one and couldn't build one. But you can paint that scenario where you say, we start here and we end up here, and this is how the interlinkages between the different risk types play out in time and across risk types, across geographies. Right, so having a good scenario definition process is one way of tackling those. Another one on a more detailed level, if you will, is, I would call it almost wargaming, right? So what would happen if we have an event, a rogue trading event? And you can take historical case examples as a starting point to think about this, right? You need to overcome the pushback in your organization that you will likely get from saying, oh, this can't happen here, right? Happened somewhere else, can't happen here. Or if it has happened before, it won't happen again, right? This time is different. So you need to overcome those and then go through the process, as you described before, of really going through the details. How would that play out? What would be the effect? And quantify the impact, right? But that is almost on a case-by-case basis,
Yeah.
rather than a integrated stress testing, top of the house kind of exercise.
Thanks, Wolfram. I just have one small comment. The unquantifiable risks, which are qualitative in nature but that have big consequence, consider amplification in the shadow banking or shadow financial institutions. So while the banking industry, financial institutions are regulated, but the shadow banking institutions are not. And their unregulated risky behavior does cause financial turbulences and tsunamis elsewhere. So when it cannot be quantified and it's unregulated, that's the worst of all. And that happens. And it's probably, if my clients were regulators, if they say the thing that keeps them awake in the night is those unquantifiable risks that bring the house down in the shadow banking sector. Any other questions, comments? In absence of that, I'd like to thank our panelists. Would you please give them a big round of applause? I'll sum up our conversation. Oops. Start the presentation. Very quickly, we learned together that stress testing is a subset within risk management. Risk management have to be practical, they have to be top driven, they have to involve the front line. And in summary, if you would want to have talk about macro factors of success for stress testing, it starts with the board and governance as a subset of the enterprise risk management. Very important for the stress testing to build capability, to model, to create, to communicate, to quantify, to assess the qualitative issues, and also to have a very strong resolution. By resolution, what I mean is, in case of likely adverse event, what are we going to do? Are we going to sell certain assets? Would it be a fire sale? What it would not be? That kind of resolve has to be predetermined. And central to all that is communication. The banks have to communicate at many levels. The job of Dr. Zhao and Anju becomes ever more important. And in Asia, we are observing stress testing days are coming up. So please build your capability. And if there's any question, reach out to any one of us. I really thank you to go through. I'm normally a little less boring, but the topic as such asked me or compelled me to keep my jokes aside. So thank you again. Have a lovely evening. And thanks to AICV for inviting us.